Today, we're going to dive into some considerations that you need to think through when managing your taxable brokerage accounts. We're going to talk about key terms, some strategies, and some inefficiencies that we see on a day-to-day basis. At the end of the day, we want you to keep more of your earnings. You can do this by implementing proper tax strategies when managing your non-retirement investment accounts. Here at Virginia Asset Management, this is what we do on a day in and day out basis to help our clients create efficiencies within their portfolio. Without proper tax strategies and considerations, you might be surprised at actually how much less of your interest earnings you keep.
A great example of this is when we're in a high interest rate environment. People often think, hey, I'm earning 5% on my CD at the bank or credit union. But that's not really what you're keeping. If you're in the 24% marginal tax bracket, if you've earned 5% on a $100,000 CD, you earned $5,000. But after accounting for the tax bill associated with those interest earnings, you've actually only earned $3,800 or 3.8%.
As you can see, it's very important to take into consideration the taxes owed on your interest earnings. Before we jump into some strategies that you can implement, we need to make sure we take into account some of the definitions. On your screen, you're going to see some key terms and definitions. If you're unfamiliar with these terms, pause the video and read these. If not, we're going to go into some examples that help bring these to life.
One of the basic things every investor needs to know is what is your marginal tax bracket or your marginal tax rate. What you see in front of you is the 2024 tax brackets in the tax schedule. So for example, let's say you're married filing jointly and you have $100,000 of taxable income. You are in the 22% marginal rate. Why does that matter? Well, the next dollar you earn of interest earnings or employment income is taxed at 22%. That also has a huge impact on how any capital gains are taxed, how any dividend income is taxed, which is an important part of keeping more of what you make. So what are some ways you can earn money on your investment accounts? Well, you have capital gains, either short-term or long-term. You can have dividend income that are qualified dividends or non-qualified dividends. A third way of earning money on your investments is through interest income, and a fourth way is through capital gain distributions associated with mutual funds.
Without proper tax strategies and considerations, you might be surprised at actually how much less of your interest earnings you keep. Capital gains are either taxed as long-term capital gains or short-term capital gains. A long-term capital gain is when you hold that asset for longer than 12 months. An example of a long-term capital gain is when you purchase a stock and you sell that stock at a gain more than 1 year later. If you buy a stock for $100,000 and you sell it 13 months later for $130,000, $30,000 is your realized long-term capital gain. That is the amount that you will owe taxes on. Your marginal rate will dictate what rate you will pay on those $30,000 in gains. It will either be 0, 15, or 20, depending on what your marginal bracket is. A short-term capital gain is when you sell an asset at a gain less than 12 months. For example, you buy the stock for $100,000 January 2nd, you sell it in March for a $30,000 gain. That $30,000 of capital gains is taxed at your highest marginal income bracket. So if you're in the 24% marginal tax bracket, that short-term realized gain will be taxed at $7,200.
So let's talk about dividend income. You can have qualified dividend income or you can have non-qualified dividend income. A qualified dividend is paid typically by a publicly traded company every quarter, and it's treated like long-term capital gains at long-term capital gains rates. If you own an asset that's determined to have non-qualified dividends, that's going to be taxed at your highest marginal rate. So for example, if you own shares of stock and it produced $30,000 of dividend income throughout the year, if it was a qualified dividend, it would be taxed at 0, 15, or 20%, just like the long-term capital gains rate. If you had non-qualified dividends by owning an asset like a REIT inside of your taxable investment account, that $30,000 of non-qualified dividend income is going to be taxed at your highest marginal rate. It could be 22%, it could be 32%, it could be as high as 37%.
Interest income is income off of a certain type of asset like a CD, corporate bond, or a money market mutual fund. Interest income is always taxed at your highest marginal rate. So if you had a CD worth $100,000 and over the term of the CD, it paid you $30,000 of interest, that $30,000 would come in at your highest marginal rate.
As you can see, investment earnings are taxed several different ways, and that can have a significant impact on your after-tax investment returns. This is why you want to be as strategic as possible as you're investing, so you're not caught by surprise by having a big tax bill after the year is over. With proactive planning, thoughtful decisions, you can mitigate your tax bill year in and year out.
Now that we have some definitions established, let's talk about some inefficiencies and maybe some better strategies you can think through as it relates to your investment management. An example is owning corporate bonds versus municipal bonds in a brokerage account or a non-retirement investment account. Municipal bond interest is not taxed federally, where corporate bond interest is. So you need to think through in your situation, does it make sense for me to own municipal bonds or corporate bonds in my taxable investment account?
Another great strategy that exists that a lot of investors don't take advantage of is tax loss harvesting. Markets don't go up every single day. There's often volatility throughout the year. So if you own an asset that's currently at a loss relative to what you paid for the asset, you might want to consider actually selling that asset or that stock, realizing the loss. Therefore, you can use those losses to offset any capital gains you might have in the future. For example, let's say you bought a mutual fund for $30,000 and it's down to $25,000 in value due to circumstances beyond your control. You may want to consider actually selling that mutual fund, recognizing that $5,000 of losses. If you don't have any capital gains the rest of the year, you can use $3,000 of the $5,000 of losses to reduce your income, therefore saving you money on taxes that tax year. The next calendar year, you can carry forward that $2,000 of losses. So if you sold an asset at a $3,000 capital gain the next tax year, you would only owe $1,000 of capital gains because you had carried forward $2,000 of losses.
Capital gain distributions for mutual funds are oftentimes unknown or unexpected. A way to avoid these capital gain distributions is evaluate a different type of mutual fund, such as an index fund or a more passive ETF approach.
Oftentimes when we meet with new clients and we're evaluating their taxable investment accounts, we will notice they have actively managed mutual funds in those accounts. That's not a good thing or a bad thing, but it could create a tax bomb for the investor without them knowing it. An actively managed mutual fund has to distribute any capital gains they recognize that tax year. So if that investor owns that fund after the record date, they're going to owe taxes on those capital gain distributions without actually selling out of the shares of the fund. A different approach could be used. You could actually invest more tax efficiently by using tax efficient investments such as individual stocks, index funds, ETFs, or individual bonds. That way you have control over when you sell those assets and you have control over the tax bill versus turning the money over to a money manager who is recognizing gains that you're paying taxes on.
At the end of the day, it's not what you make, it's what you keep. And you can keep more of your investment income by being tax efficient when managing your taxable brokerage accounts. The best thing to do is get familiar with all the different tax strategies that you can implement or evaluate offloading that to an advisor to do that for you.
And oftentimes someone will say, hey, I already have an advisor. So a great question for you to ask that advisor is, how are you managing my assets to get the highest after-tax rate of return for my situation? One of our goals of Virginia Asset Management is to make sure you as an investor are keeping more of what you're making. If you're managing the money yourself, make sure you're taking advantage of the tax laws that are out there and some of the strategies we've outlined. If you're not comfortable making those decisions by yourself, feel free to contact an advisor of Virginia Asset Management.